welcome everyone. Thanks for joining us for this economic and market update. My name is Brad Kelly. I'm the principal in charge of our financial services group here at Eide Bailly. And joining me today is Dr. John McDermott, who is the chief investment strategist at Symmetry Partners. And we're looking forward to his comments today. What we want to do today is spend part of our time looking back at 2022 and looking at the market performance for last year, and really look at what drove outperformance, what drove underperformance, and how did portfolios behave last year. Then we'll turn our time to looking ahead to 2023. Markets are having, Dr. McDermott, they're having a very good day today, but can we expect that throughout the rest of the year? So we'll talk a little bit about what the evidence is showing us around that as well. And as Amy said, I do encourage you to ask your questions in the Q&A feature. We'll be going through slides today, but we do want to try to keep this somewhat interactive today as well. So feel free to ask your questions, and we'll try to field those as we're going through the slides, and then certainly try to address those at the end of our conversation today. I think it's appropriate, Dr. McDermott, to just set the stage for us before we get into 2022. Really our perspective on how we view the markets as evidence-based investors, and really the scientific approach to investing, because I think if we spend a little bit of time on that and getting that perspective, it will help us really look at what did we see in 2022. So with that, maybe I'll have you comment first of all on evidence-based investing and what is that and what makes that up.
Thank you, Brad, and thanks everyone for joining today. What a thrill to be able to talk to. It looks like almost 700 participants, which is just amazing. I welcome all the opportunities that are afforded me to work with Brad and to work with the good people of Eide Bailly. So thanks so much for being here. So I have a few slides on introducing evidence-based investing. But it's somewhat self-explanatory, right? We're not going to try to outguess the market, but we're going to try to learn from the research that has been done on the market by academics, by practitioners, over the history of recorded data of securities markets, which dates to the early 1920s in the United States, right up to tick-by-tick data today. So with that, maybe we could move to the presentation. So the history of evidence-based investing, dates back to the invisible hand of Adam Smith all the way through the more recent writings of our partners at DFA, Ken French, and Cliff Asness at AQR Capital, and Andrew Ng at iShares. These scientists, financial scientists, have looked at the evidence that's available in financial markets about what are the drivers of returns. And what they've kind of coalesced around, and it's our view of the markets, is that you can find factors that drive returns, and you can identify these factors, and you can use them as a way to orient your portfolio to try to increase the return relative to what you would just get by buying, say, the S&P 500 or buying a Russell 3000 index fund. So these sorts of returns or premiums or higher returns typically fall into two buckets. One is a risk bucket. Higher risk strategies are expected to have higher returns. And investor behavior. Not all investors, or not the investing public in general, doesn't always act in what we consider a rational way. And if we can have an explanation that that's behaviorally motivated for some of these sources of returns, that's okay with us too. We'd rather have the risk-return relationship, but a behavioral story, as long as it's plausible, is also can be powerful. So just in the simplest example I can give of a factor is the equity risk premium. Equities outperform treasury bills. We or expected to outperform Treasury bills. We understand why that is. Equity is riskier than Treasury bills in all senses. And in order for investors to invest in equity relative to Treasury bills, they have to be induced by additional expected return. That's the premium. So that's the most simple. And I think everyone on this call understands what gives rise to the equity risk premium. But there's also other factor returns. And we can think about these factor returns as being similar to a long-short hedge fund strategy. So for example, one is the size premium, is that small stocks have tended to outperform large stocks. And we could think about small stocks as being riskier than large stocks. Another is a momentum premium, up minus down, where stocks that have recently done well relative to stocks that have recently done poorly results in a premium, and that's known as the momentum premium. So we have quite a few factors that we pay attention to. Our list of factors is not much different than other factor, multi-factor equity managers. The first I mentioned was market. The next, and probably the most prominent, is value investing, which we are certainly value investors, and that's the tendency of low price multiple stocks to outperform high price multiple stocks, so value to outperform growth. And that's been about 2% a year in the recent history of the US market. Size, I mentioned. Quality, higher quality companies as measured by profitability and other balance sheet metrics related to default and volatility tend to outperform lower quality companies. And that's a premium about 4% a year. I mentioned momentum. That's a really large premium there for stocks that have recently outperformed relative to stocks that have recently underperformed. But recall that these, or know that these factor premiums don't reflect transactions costs, and momentum strategies are pretty high transaction strategies where transactions costs will eat away at that premium. Say in comparison to the market, where you can own Vanguard Total Stock Market Index for essentially zero and capture the entire premium. That is not the case with momentum. And then the last equity factor that we subscribe to is this low volatility factor. It doesn't give rise to a premium, but it does allow you to improve the risk return profile or risk adjusted return of a portfolio. And it's the tendency of less volatile securities to outperform the most volatile securities. All of these factors are substantiated by substantial academic research, both in the United States and markets outside the United States. In fixed income, you probably have very familiar with the fixed income factors, interest rate risk, credit risk, and there's other factors, liquidity, duration and call extension characteristics. But we're looking at more modest premiums in the fixed income space. And there's recent research suggests that some of these equity factors actually work in the fixed income arena as well. And we at Symmetry are actually looking into moving our fixed income strategies more to be to take into effect more factors rather than just interest rate and credit. So the way we view the markets, and I'll get to the punchline, is the conventional view is the market gives returns, and anything over and above the market we call alpha. And that alpha can be generated by active managers by either doing fundamental analysis and stock picking. They can be doing technical analysis and getting in and out of stocks or in and out of markets based on market signals that are reflective of past prices. Evidence-based investing says, well, some of these factors can explain a lot of conventional alpha. And if we take into account the factors, we can generate a good portion of what fundamental and technical analysis would generate in alpha by being systematic and evidence-based and tilting our portfolios to these factors. Notice we didn't eliminate the alpha on the right-hand side. There are undoubtedly great investors out there who have consistently outperformed the market and are truly generating alpha. I think of Jim Simons at Renaissance Technologies, who's had just an incredible track record over decades. The problem is that he won't let you invest in his fund. And if he did, it would be a very, very high cost to capture his rents. Another source of alpha that Brad and I talk a lot about is tax alpha, that there are things that you can do with certain strategies that can generate alpha. You could think about as maximizing after-tax returns relative to pre-tax returns. So that's our view and the way that Brad and I and our investment committee, and we're putting together portfolios, that's kind of the lens that we use to construct the portfolio, is tilting ourselves towards these sources of higher returns relative to what the market says. Brad, you have any thoughts on factor-based investing or evidence-based investing that you'd like to add?
Yeah, so a couple of things. So you showed the premium, the source of premium return by factor. So let's just talk about value for a second. There's a 2% premium, but that's not there every single year, correct? Let's maybe talk a little bit about that, because for a lot of our callers, probably thinking back to the financial crisis of 08, 09 time period, coming out of that, and really up until just recently, within the last, maybe 18, 24 months, growth has really outperformed value pretty enough to move the needle, right, significantly. And so that premium, that source of premium, has not been there for a period of time just in recent history. So maybe just talk a little bit about that and what those cycles might maybe look like.
Yeah, thanks for bringing that up. I'll go back to the equity risk premium first, and then I'll turn to value. So the equity risk premium, you can think about 5 or 6%. We know it's compensation for risk. We know that in years like 2022, we could be down 20%. We know years like 2008, 2009, we could actually be down like 45 or 50%. So we inherently know that over the long term, that this premium should surface. But in the short term, or even the medium term, the risk can be manifested on the downside, and you can have meaningful down periods for even the equity risk premium. When I talk to investors, one of the questions I usually ask is to make this point more vivid is, I ask, what percentage of rolling 10-year periods in the history of US markets do you think that the S&P 500 underperformed treasury bills? And a lot of people will say 0, thinking that 10 years is certainly long enough time to realize the equity risk premium in the United States. Well, it turns out it's more like 15% of the time that even a 10-year rolling period is negative. So you asked, Brad, about value, and it's very relevant because value, although it had a great year in 2022, pretty good year in 2021, 2019 and 20 were awful for value, historically awful. That's really the risk of the value premium exerting itself, no different than the risk of the equity risk premium. And all these premiums that we have significant standard deviations, meaning that they can have positive realizations and they can have negative realizations.
Yeah, that's helpful. And maybe before we jump into to 2022 performance, you'd mentioned some alpha opportunities in the idea of managing taxes, and that, I think, really came into play in 2022 with the market underperformance. It's not uncommon. We'll talk to clients and clients that have held positions for a long period of time, where the markets were just going up and up and up every year, and all of a sudden you have this unrealized gain that kind of locks you into an investment. It's very difficult to unwind it and trigger the taxes on that. So the idea of tax loss harvesting on a more systematic basis. Can you just comment a little bit about that before we get into 2022? Because there was a lot of that happened, and I know we did with clients. We took advantage of the downturn in the markets, recalibrated portfolios. We were able to harvest some losses, offset some gains. But that over time, if you do it correctly, really enhances performance and creates that alpha that you talked about. Can you just comment briefly about that as well?
Absolutely. As financial advisors and tax advisors, I'm sure you're engaging, especially this year, in tax loss harvesting in an attempt to capture these losses, which can be carried forward right now, I think, indefinitely. Even in a mutual fund or an ETF portfolio, you may have positions that in a year right now, probably fixed income positions, because fixed income gains over the last 3 to 5 years have kind of been wiped out, that allow you to selectively harvest or sell and realize those losses. One of the developments that Brad and I have been working together on to bring to Eide Bailly is doing direct indexing, which is where you actually hold the individual securities in a way to capture the factors and to hold a portfolio of securities. And even if the market's up, some securities might be down, right? In a market that's down, many of those securities are going to be down. So it increases your degrees of freedom for doing tax loss harvesting if you hold a portfolio of securities. Another really interesting thing that we're working on is bringing in long short portfolios where you have 130% long and 30% short. So even in rising markets, the short positions will experience losses, and in falling markets, the long positions will experience losses, which allows you to tax loss harvest in both rising and falling markets. So there's a lot of excitement and innovation around generating tax alpha, and I'm sure you'll be hearing more about that from Brad and the Eide Bailly team going forward.
All right, thank you. We better turn our attention now to 2022, and let's just look at how the markets did perform and these various factors that you were just talking about as well.
Sure. Just as a quick hit on 2022, I'm imagining that most of you are somewhat familiar with the numbers, right? It's been a terrible year for investors. There's really very few places to hide. Terrible means, the equity markets were down about almost 20% in 2022. S&P 500 didn't matter much whether you were large or small. If you were heavy in technology and in those growth stocks, it was even a worse year with the NASDAQ Composite 100 going down over 32%. If you were in the technology sector, that was not quite as bad, but down 27%. And if you were in a highly concentrated technology portfolio like ARK Innovation ETF, that was down almost 67%. So some of these growth names, technology-oriented growth names, had a really, really difficult year. The good news for a value investor is that means that value did better and growth did worse, and I'll get to that in a moment. The markets outside the United States, developed markets outside the United States, didn't do quite as poorly as the United States, but emerging markets was down around 20% as well. So global equities down sharply in 2022. What's a little different about 2022, unfortunately, was normally we expect the bond part of a portfolio to kind of be the rock, right? And to weather these difficult years. So to exhibit low or zero correlation to equity. Well, that wasn't the case in 2022. Whether you were looking at investment grade or high yield, bond markets were down a little more than 10%. So we didn't get that benefit of kind of a rising bond market at the same time that equity markets were falling. We know the reason for that is typically centered around the Fed raised interest rates 7 times total in 2022. We started out with a Fed funds target of 425 bips at the beginning of the year. And now the current target is 425 to 450 bips. So significant rise in short-term interest rates, and that corresponded with rises in long-term interest rates as well. So in terms of that nowhere to hide, it didn't really matter much whether you're on the short end of the curve or the long end of the curve, you still went down, right? Because short-term rates rose as well. On the real economy side, there are signs the U.S. economy is slowing, but the labor market is still quite strong. Civilian unemployment rate is at 3.7%. Payroll employment, non-farm payroll employment was up in November. CPI is still high, but there are signs of easing. CPI was 7.1% year over year in November 2022, and the new number shows CPI at 6.45% year over year. So for 2022 was 6.45%, which was down from 9% at the end of June for a year over year. So while inflation is still elevated relative to historical levels, it is slowing. So of course, the hope and the market's hope is that the Fed will be able to achieve this soft landing of bringing inflation under control without driving us into a recession. Speaking of recessions, one measure or one indicator of a recession on the horizon is yield curve inversion. At the end of 2022, the 10-year rate was lower than the 2-year rate, which is inversion, at about 0.5%. And the curve has been inverted since July, so for a long period of time. Previous research by Campbell Harvey of Duke University would suggest that this is indicative of a future recession. The dollar did strengthen and up 7% over the euro over the course of the year, but Bitcoin crashed, and there's a lot of suggestion that Bitcoin is really not acting like a currency, but more like a risk-on asset, being down 64% in 2022. So it was a difficult year overall, but I'd like to, bring to your attention the idea that investing in equities and investing in general is a long-term prospect, and it's much better to take a longer-term view, even though the pain of the short term is difficult to ignore. You only have to look out about 3 years in equities to see positive returns, right? This past year was terrible, but if you go back 3 years, you're in positive territory. If you're going back 10 years, it looks really great. And 20 years, you're back around that 10% year over year long-term average, right? Emerging markets has been kind of a weak spot in a global equities portfolio. You have to go back greater than 5 years to see positive returns there. Some of that certainly is being driven by COVID in the year one numbers anyhow. So take a long-term view. I think it's helpful for us as investors to do that. There's a lot of noise in the short term, and reacting to it typically doesn't help our wealth situation. Same thing in fixed income. You have to go back a little further to see positive fixed income returns, more like 5 years. But still, when you go out to the longer time periods, you see positive returns for investing in fixed income. So factors, how did the factors do in 2022? If you were tilting your portfolio towards value, quality, and momentum and minimum volatility, did it help you or hurt you relative to the market returns that we just saw? And the answer for value is most certainly it helped you. The US prime market, which is large value, was only down 5.26% in 2022. And the small mid-cap value was only down 5.63% in 2022, as compared to 20% for the market as a whole. So a value tilt in 2022 is a very positive, had a very positive outcome in a relative sense, right? We didn't underperform the market as much if we were tilted towards value. The other momentum did okay, a little better than the market. Quality not so great, and minimum volatility actually had a very good year as well. So did anything do well in 2022? We just saw, in a relative sense, that value tilted or minimum volatility tilted strategies will do well in relative terms, which is to mean that they'll not necessarily have positive returns, but not be as negative as the market as a whole. In absolute terms, actually, trend strategies had a very good year. And I'll talk a little bit more about that. And there are investors who are running market neutral value strategies. So those strategists are going long value and short growth, and they're getting the differential return. And as you saw, that differential return was quite meaningful. So market neutral value and trend strategies actually had pretty good absolute terms, performance, positive performance. As far as the Eide Bailly strategies, the US equity was up and the US defensive equity was up, and they outperformed the MSCI USA index on a net composite basis. And those are really impressive numbers for 2022. The US equity sector and the defensive equity sector, defensive, as you might suspect, has a minimum volatility component to it. And the US equity strategies have a pretty significant value component to them, as well as momentum. So very good year for those strategies, both on an absolute and a relative basis. We have what's known as a sector momentum strategy that had a great year. And the sector momentum strategy will invest in the top 3 to 6 sectors in the S&P 500 based on their recent performance, meaning going back 6 months and going back a year. So looking back in 2022, the sector momentum strategy was invested in energy for the majority of the year, if not the entire year. And energy had a very good year. So those are excellent gross and net composite returns for 2022. Eide Bailly Alternatives, which has a trend following component to it, the alternative strategy had a fantastic year again, up greater than 10% on a gross basis and greater than 9% on a net of fees basis. So there were some places to hide. And Brad and I would talk, well, if we only knew to invest in these 4 Eide Bailly strategies at the beginning of the year, it would have been a great year. We could have ignored all this bad things that were going on in the market. But I think it really speaks to being diversified across many strategies in order to not find yourself in a particular ill-diversified position getting hammered, right? I wanted to talk a little bit about trend-based strategies, just because trend-based strategies have a little to do with sector momentum and a lot to do with the alternatives performance. In general, trend strategies did really well. There's a trend index that's up over 27% from Societe Generale. The managed futures trend strategy that's part of the alternatives portfolio at Eide Bailly, as a component of that portfolio, was up over 35%. So that portfolio is investing in trends across equity, fixed, commodities, and currencies. And in commodities, oil was trending, so it was long oil. In equities, value was trending, so it was long value. And in fixed income, things were trending down, so it was short fixed income, right? So all these things together, the fact that we have a 1 or 2 year trend that's continuing, meant really great things for the Eide Bailly Alternatives portfolio, as well as the managed future. why does trend work? Well, it doesn't work when things are choppy and bouncing around, but it does work when things are trending as they have been over the last year or two. And I did mention as well earlier that commodities did well in 2022, led by energy and agriculture, energy being up 43%. Interestingly, precious metals was kind of flat. And usually you think about precious metals as being a hedge against bad times. It turned out that it didn't really come through as that hedge against bad returns. So I think what I'm pointing out in this slide is there were some bright spots in the market. Eide Bailly clients were invested in those bright spots, whether it be value or momentum or trend following. So resultantly, I think for the majority of investors in Eide Bailly Financial Services, that the year wasn't as bad as it would have been, just being a straight indexer. Any thoughts on performance in 2022, Brad?
No, I think you covered it well. And this slide certainly just shows, I think it's just a continuation of what you were talking about. Just highlights the different strategies, portfolios that we have here at Eide Bailly, and just highlighting performance for the year. And most of our strategies outperform their relative index. And that's just because of the diversification and leaning into some of the factors that you were talking about at the beginning of our talk today. So we were pretty pleased, and I think our clients were pretty pleased with performance as a whole for 2022. And I think you're going to talk about, as we go into 2023, some of the trends that maybe lifted our portfolios last year might be continuing as we go on into 2023, certainly in the value factor component.
Right. And this slide is color coded. So the green shaded returns for the Eide Bailly strategies relative to their index indicate that Eide Bailly outperformed the index. So for example, for the US equity, you could see the outperformance relative to the index is something along the lines of 5 or 6%, right? That's those relative outperformances.
Yep.
The true bright spot here is the sector momentum, which has positive absolute returns, as well as the alternatives, which have positive absolute returns, as well as beating their index. And that's some more. This is the portfolios that are made up of the sleeves. And again, you can see a lot of green there, meaning relative to the index, it was a pretty good year. So as Brad mentioned, looking ahead, this is a tough question, right? But we get all the time as advisors is, well, what do you think the market's going to return in the future, right? What does the evidence say about that? Well, in the simplest iteration of that is, well, U.S. equity markets tend to be up about 10% on average over history, about 6% real, 10% nominal, 6% in addition to inflation. But that's not taking into account all the information that we have, right? We know after a period of falling equity values, that expected returns should rise. And after a period of rising equity values, expected returns should fall. And the measure that gets the most publicity is the Shiller CAPE PE, cyclically adjusted PE ratio. And at the end of the year, the Shiller PE, which looks back 10 years and is inflation adjusted, so it's not truly the PE ratio of the S&P 500. It's manipulated a little bit. It's about 28, but it's down from 37 at the beginning of the year. So PEs have come down, as you might expect. Prices have come down more than earnings have come down, right? And you can see that in the sharp downturn here. So PEs are high relative to history. The mean historically is about 17. So you could take that as being markets are overvalued, right? That would be, one way to think about it. Or the price of earnings is too high is another way of kind of bringing that idea. So what does that mean for investors? Well, if we look at the data, we're in the 10th decile of the Shiller PE ratio. And if we look at the 10-year returns, every time we're in that 10th decile historically, the average return is quite low, 1.2%. And you can see there's a pattern, monotonic almost, that shows as your starting PE is low, your realized 10-year returns are high, right? It's not to say that it's always super low. The best return, around decile 9 and 12 was somewhere between 6 and 12%, which is not a bad 10-year return. And the worst returns have a narrower band, somewhere around 5%. But it doesn't really, the data or where we are with respect to PEs for the market as a whole is not overly optimistic, right? You could say the same thing for bonds, like where we are for bonds isn't actually a great starting position either. So, why would I show this? I think in terms of dealing with your clients or thinking about your own situation, it pays to be conservative in forecasting future returns. Put simply means save more and spend less, right? That's to meet your goals, which is the simplest financial advisor advice you can give, but probably the best financial advisor advice you could give. How about value? So this is somewhat of a difficult chart to get through. So I'm going to start with the bottom line. I'm going to start with the import of the slide first and then work backwards. If we look at value versus growth and their PE, US large cap is almost at a historical high, meaning that the PE of value stocks versus the PE of growth stocks is, the difference is quite large, right? If you move back to where they are historically, that would be a good thing for value, right? Because the PE ratio of value stocks would be rising and the PE ratio of growth stocks would be falling, and value stocks would be doing better than growth. So historically, we see the spread between value and growth as being 2 to 3 standard deviations from the mean. That portends strong value returns going forward, given we revert to historical levels, right? This has come in a little bit since October. We're still because value has done well since October. We're still around the 95th percentile, or 2 standard deviations from the mean, which puts us kind of where we were right around when the dot-com bubble burst, right around where we had the great financial crisis, and right around this recent value resurgence. So historically, what this means to me is I think it's a good time to be a value investor. I actually think it's always a good time to be a value investor because the expected returns are higher. But I think in terms of timing value, it would be a poor time to get out of value. I think that the opportunity is great in value stocks. So what can we expect going forward? As a value investor, what I would like is kind of a slower reversion. This yellow line here, where the PEs kind of come in closer to historical, but they do it slower. And the reason for that is the interaction with momentum. If value stocks start to slowly do better than growth stocks, then value stocks will start to become part of our momentum emphasis, and you'll have value and growth both performing well at the same time. It's not to say that things couldn't get worse. The historical spread between value and growth, as indicated by this gray line, could get worse, which would mean more or not good times ahead for value. But I think given that we're at a 2 or 3 standard deviation distance from normal, I think the chances of further widening, at least in the long term or medium term, is quite low. Any thoughts on previous slide, Brad? On the
No, I mean, I
timing of the
think
value
that,
premium?
yeah, I mean, I just think that it does, the data is showing that there's a strong case for value going forward. And, I think that investors as a whole, prior to maybe the last year and a half, gravitated more to the techie type portfolios, which had a great run, but got hit really hard last year. And I think there's a case that that might continue going forward, and this rotation toward value will maybe be here for a while. So I think it's important to assess your portfolio, and diversification is absolutely critical. But having value represented in your portfolio, I think, will serve you well.
Yeah, I think it's really interesting that the last time we had this kind of dislocation, you could see right here around 1997, we were right at a normal value spread. And then you had the .com run up and this real dislocation between value and growth PEs. And the only other time that looks remotely like that is the period of 2017 to 2020, where we have this kind of similar taking off of growth stocks, followed by a pretty significant crash, at least in 98. So I always try to, we've all been in finance and investing for a while, and I always try to think about what are the lessons that I should take away from this painful time period, right? This last few years. The last time I went through this exercise was in 2008, 2009, following the great financial crisis. But I think the primary lesson is that diversification works. There's a misunderstanding sometimes about what diversification can do for you. By definition, diversification results in just bearing market risk. And you can't diversify a market risk unless you are not in the market, right? That's the only way to diversify it away. You can't diversify market risk by adding more securities or adding more asset classes, because all you're doing is you're driving towards holding the market. We have to think about diversifying greater than equities and fixed income. I think that's the lesson that I take away from this particular crash, is these pockets that have done well are in what I would call kind of especially trend and market neutral value strategies and minimum volatility. They're not they don't what you think about as being traditional diversifiers, right? We usually think about, oh, we have our equities, we hold all the equities, we buy bonds to diversify equity risk or buffer equity risk. But I think looking beyond just equities and fixed income as the asset classes you're interested in improves your diversification and will help you in times like these. This low correlation between equities and fixed income is related to the diversification, right? That in short periods of time, we've seen where it can increase dramatically. And we haven't seen that in quite a while. And it's kind of ugly when it happens, right? Because you're in that 60-40 portfolio and you're thinking that the fixed income is going to carry the day in these tough times. And then the 40% that's supposed to hold up its weight is going down 10 or 15% as well. Those are tough, right? And I think it speaks to the need to diversify further or to think further about diversification beyond just equities and fixed income. And what are those what are those other diversifiers? They're alternatives and they're trend-based strategies. To a certain extent, they could also be private assets. I'm a little wary of private assets. I didn't put that up here, but I think there's some diversification benefit to private assets as well. And that's kind of what I'm taking away from this crisis personally, and what bringing back the symmetry and to our discussions with Eide Bailly in our investment committee. So with that, let's check in and see if we've got some questions queued up,
Yeah,
Brad.
so if anybody has any questions, please submit those. We've got a few minutes left. I would just mention, and I was reading recently that in the history of the market, we've never had a year where both fixed income and equities were down double-digit negative returns in 1 year. So that's somewhat unprecedented. Well, it is unprecedented. It hasn't happened before. And I think the lessons learned there is that bonds do have risk. I think that a lot of investors think the bonds low risk, the safety plays for my portfolio. And we did see last year that the risk that does come with fixed income. And then the alternatives, I mean, I think the advancement of technology has allowed us now to look at and have these new strategies that are coming to the forefront to diversify away some of that risk. I'm looking through, we've got questions coming in here. Just take a look here. So one question on the tax loss harvesting alpha that we talked about kind of brought up the idea of wash sale rules, which is something certainly to consider when you're implementing that type of strategy. But I think, and I'll let you comment on it, I think it's more difficult to do in a fund environment than individual security environment. And so I don't know if we would implement that with exchange traded funds, but certainly much easier inside of an individual security portfolio. So maybe just a quick comment on that.
Yeah, I agree, Brad. It's certainly in terms of implementing a tax loss harvesting strategy, dealing with individual securities is going to be more effective. You have a lot more different opportunities for dispersion of returns, where if you had a portfolio, say 10 or 12 ETFs. But the specific question here is, the tax loss harvesting would be, you sell the S&P 500 ETF if it has a loss, and then you go back and you buy the Russell 1000 ETF, right? You'd have to talk to a tax advisor about that. But my understanding of the wash rules is that the IRS has been kind of ticker sensitive, that they don't go and look at the underlying assets, which would be more in the spirit of the wash sales law. But you guys are the CPAs and you understand those rules better than me. But the way we've been implementing, as long as you're not buying and selling the same ticker, we feel like we're meeting at least the letter of the law with respect to wash sales.
Certainly an item to consider when you're implementing that strategy. Do you have any thoughts on, I've got a question on, have you compared at all the environment of the 1970s, the market, the landscape? Is there any comparison to what we've been seeing more recently?
I haven't given that a lot of thought. Certainly the aggressive hiking of interest rates by the Volcker Fed in the 70s to bring inflation under control. But I mean, if I recall correctly, and I was studying this when I was in an MBA, but I think short-term rates got into the high teens in those times, and the stock market was basically flat for a decade. The U.S. stock market was flat for a decade. So it was a lot more of an extreme version of what we're going through now. And my hope, and I think it's playing out this way, is that we're not going to get to that point where we need to have a 15% Fed funds rate, and that we're going to crush the economy and crush the stock market in doing that in order to get inflation under control.
Yeah, we're seeing, before the call today, we were talking about, part of what the Fed wanted to see in raising rates, a number of things, but one was start seeing some layoffs, and we're certainly seeing that now with some of these tech companies that have announced some larger layoffs, which are happening. In which we actually talked about bad news is good news for the market, and we would see these announcements which actually drives the market forward, which, has a positive impact on earnings. Here's a good question. Back to more of a scientific based approach to investing, and along the vein of tax loss harvesting, but rebalancing. What do studies show about, is there an optimum time to rebalance a portfolio to maximize return? What do we have any studies that show what that might be?
Yeah, that's actually it's a great question with a very complicated answer. Optimal rebalancing is trading off the cost of trading versus which, if you rebalance, you're gonna have to buy and sell, right? And there's costs of that. There's transactions costs. There could be tax costs associated with that, versus the utility that you gain for being in the correct portfolio, right? So if you're in a 60-40 and things are doing well, and now you're in a 65-35, well, you're a little bit too risky for what your utility should be. So you should rebalance, and you gain some, you get a benefit from that. So that trade-off is what goes on. Optimally, in terms of, or operationally, the way we rebalance typically is we do it periodically at a 1-year basis, and we have a rebalancing threshold that has to be hit in order to incur the transactions cost, which will keep you pretty much on target. So it's a complicated question with which I don't have a great, I would say the answer to the question is no. There's not a perfect period of time, but there's a framework for understanding the trade-off between trading more and being on target, what the importance of being on target.
Certainly outside of that 13th month time period, to just back to the tax component of long-term versus short-term gains and the erosion that could have on the portfolio as well. Here's an interesting question, and I'll be curious to hear your thoughts. So is there more cash chasing fewer strategies, if you will, or maybe the market? Let's talk about the market as a whole. So if there's more demand and less supply, is that going to mute returns over time? And that might play into the fact that we're seeing these private equity, private debt, we're seeing other opportunities in the alternative space, but I don't know if you have any thoughts on that.
I think if I completely understand the question.
Well,
so the supply and demand for investments in general,
yes. Yep,
investment strategies.
Right. And will that lower returns?
Certainly there's this idea of anything that's overbought is going to have lower returns, right? That's actually the premise behind a factor strategy, right? If I look at value versus growth, if they had the same expected return, but yet growth was preferable to value, nobody would want to hold growth. Nobody would want to hold value. Everybody would hold growth. So once people start to pile into growth, its price goes up and its return goes down. If people shun value, its price goes down, its return goes up, and there's a differential return there. So you could apply that kind of rationale to any differential return or any factor or any strategy, right? So yeah, I do think there's, trading and money pouring into a specific strategy increases the price of that strategy or those components of that strategy, which reduces expected return, right? There's arguments to be made for that for, crypto, for private assets, for lots of different effects, even value versus growth.
Maybe final question. I'm just watching time, but where did that go? Precious metals. So precious metals having somewhat of a flat year last year. How do you view precious metals as part of the portfolio? And do you see any kind of a bounce, given that it had a flat year last year, any kind of bounce in 2023 in that particular asset class category?
So in the Eide Bailly alternatives portfolio, there's a precious metals component to it. It's part of a diversified alternative strategy. There have been times in history where precious metals has done what you would expect it to do, which is to gain value in a time of crisis and act as a store of value. For whatever reason, and I don't know the reason, that's not what has happened. Although I understand gold is doing pretty well since the beginning of this year, right? It had a little rally today, I think, or yesterday. So my way of thinking about that is, yeah, I think precious metals should be part of a globally diversified portfolio that includes equities, fixed incomes, commodities, alternative strategies. Would I overweight precious metals, or do I have a view on precious metals? I don't. I think it's I think it's a reasonable thing to add to a portfolio at a reasonably small allocation.
All right, excellent. Okay, well, I think we're about up on time. So, I'd like to thank everyone today for attending. Great participation, attendance today. Really appreciate that. Dr. McDermott, it's always a pleasure spending time with you, whether it's on a video like this or dinner together as well. So always enjoy conversations, and we'll plan to do this again at some point in the future. So with that, we'll let everyone go and have a great day and a great week.
Thank you, Brad. Thank you, Amy, and thanks to all the participants.